I'm Jake Pavicic.
I'm Taylor Muir.
And we're doing Chapter 22, Futures Market.
David.
So the first slide is the basics of futures contracts. As you can see in what we have highlighted, a future contract is the obligation to make or take delivery of the underlying asset at a predetermined price. And a futures price, the price for the underlying asset is determined today, but the settlement is on a future date.
The basics of futures contracts. A long contract is equivalent to purchase the commodity on the delivery date. A short is equivalent to sell the commodity on the delivery date.
Some trading mechanics for you guys. Electronic trading, it has mostly displaced floor trading, as we can see in the stock market, or I'm sorry, the New York Stock Exchange. There's not many runners anymore on the floor. It's all done by computers.
Robin Hood.
Robin.
And then trading mechanics, slide 2 of 2. Only 1 to 3% of the contract result in the actual delivering of the underlying commodity. Essentially, it gets traded long before that date where you have to sell or buy. That's why you can buy long and sell short the same day.
Margin and trading arrangements. As you can see here, the initial margin, your maintenance margin, but the most important that is used mainly is the margin call. When the maintenance margin is reached, broker will ask for an additional margin funds.
There's 2 types of trading strategies. There's speculators and hedgers. Hedgers are definitely like they're just trying to protect themselves a lot more, and then speculators seek to profit from price movement, and so it's a little bit more risky. Just like we have investors and savers. Savers are all bitching right now because interest rates are so low. They're getting kind of screwed, and we don't see it ever really changing in the near future. And the odds of recession are higher.
Futures prices. So there's 2 of futures pricing. 2 steps. You purchase it now and store it, or you take a long position in futures. Simple way to make money, honestly.
An arbitrage possibilities. The futures price is too high. You're going to short the futures and acquire the stock by borrowing money at the risk-free rate on margin. And if the futures price is too low, you're going to go long in the futures, short stock, and then invest the proceeds at the risk-free rate. Both easy ways to make money if you know what you're doing, or just buy low, sell high. And done. That's all you guys need to know of the futures market.
Thank you. So now, we hope that you really enjoyed our presentation. We're Prestige Worldwide. We have a music video up on Netflix and also a movie after us called Step Brothers. Possibly you. I love that part, dude. Thank you. Good luck, Will.
Taylor, I love your picture. So cute.
Thank you. It's junior year of high school, and then it pops up in here and it goes into what it has to go through like where it's like pending, and then it pops in and you get that and you can convert it into money for yourself. Yeah, look it up. Just look up break. Just look up break. Yes.
not like a lot, but.
Alright, so we did chapter 24, and it's about portfolio performance evaluation. So a little introduction, the markets, they're efficient. Investors must be able to measure assets management performance, and there's two common ways actually to measure the average portfolio return. And the first one is time-weighted returns, and the second one is dollar-weighted returns, which we'll go more in detail about. The dollar-weighted return is that households should maintain a spreadsheet of time-dated cash flows in and out to determine the effective rate of return for any given period. So an example would be like the IRA or the 401k. Adjusting returns risk is the simplest way to adjust for risk to compare the portfolio's returns with the returns of a comparison universe. The comparison universe is called the benchmark, and it's composed of a group of funds or portfolios with similar risk characteristics. This is just to measure. It'll keep outlining what each symbol means. So the AP is the alpha for the portfolio, the P over RP is the average return on the portfolio, the beta P, which is the rate of average beta, the RS equals the average risk-free rate, and the RN equals the average return on market index portfolio. We now have the information ratio, which is beta P over covariance of EP, which is the information ratio divides by the alpha of the portfolio by the non-systematic risk, and the non-systematic risk could, in theory, be eliminated by diversification. M2 measures developed by Montagillian and created created an adjusted portfolio P star that combines P with treasury bills, set P stars that have the same standard deviation as the market index. Now compare market and P star returns. If P or Q represents the entire investment, Q is better because of its higher Sharpe measure and better M squared. If P and Q are competing for a role as one of the number of sub-portfolios, Q also dominates because its trainer measure is higher. If we seek an active portfolio to mix with an index portfolio, P is better due to its higher information ratio. So the style analysis was introduced by William Sharpe. The regress returns on indexes representing a range of asset classes. R square.
You want to take a break?
Yeah, sorry, I just gotta get my breath back.
Just take a break. I've never seen statistics be that funny.
I'm sorry, yeah. It's just okay.
I mean, I think it's great, actually.
Okay, yeah.
It's great.
Okay, so regress. The fund returns on indexes representing a range of asset classes. The regression coefficient on each index measures the fund's implicit allocation to that style. R square measures return variability due to style or asset allocation, and the remainder is due either to security selection or to market timing.
Okay, so then we have performance manipulation in the MAH. So the assumption is rates of return are independent and drawn from the same direction. Managers may employ strategies to improve performance at the loss of investors. Performance attribution procedures. So there are 3 procedures, and a common attribution system decomposes performance into 3 components: allocation choices across board asset classes, industry or sector choice within each market, and securities choice within each sector.
You have an emerging inflation.
Set up a benchmark or a bogey portfolio. Select a benchmark index portfolio for each asset class. Calculate the return on the bogey and on the managed portfolio. Superior performance is achieved by overweighting assets in markets that perform well and underweighting assets in markets. That is all. Thank you, guys.
Who's next?
David, you next?
Wait,
This? You gotta fix this.
Okay, I'm gonna press this one.
This goes in the report. That turned out really nice.
She's good.
Dude, I was dying. I'm so sorry. It was, this
Good
one's
job,
fault.
Nikki.
She was just next to me laughing. It was making me laugh. I just couldn't back and forth, and I couldn't.
Their comments.
For,
No, I was gonna do it all and then you guys started laughing.
Bruh, see, you're gonna do
I mean, yeah. You wanted to see
So what you wanna do?
It's not printing.
There's an error.
Print this out.
I'm surprised you're here.
me too. I got it ready.
So we're on over chapter 21, option valuation. Option value. So there's intrinsic stock, there's intrinsic value, and in that there's call, which is the stock price minus the exercise price, and the put, which is the exercise price minus the stock price.
Okay.
This is the call option value before expiration. This is the graph demonstration. I should probably go into
James, when you're done.
So these are the determinants of the call option values. So stock price, exercise price, volatility, time to expiration, interest rate, and dividend payouts. The restriction on option call value. The call value cannot be negative. The lower bound equals the adjusted intrinsic value. Range of possible call options. So this is a graph demonstrating the range. So it has a call value on the y and PV times x plus the PV times v on the x. This is the call option value as a function of the current stock price.
Too much work.
For early exercise puts, American puts are worth more than European puts, all else equal, and early exercise has value because the value of the stock cannot fall below zero. Then once the firm is bankrupt, it is optimal to exercise the American put immediately because of the time value of money. Here's the put option values as a function of the current stock price. So we have graph A and graph B. Graph A is American, graph B is the European put value. This demonstrates that the European is lower than the American. Here's the binomial option pricing text template. For each upward movement of $1.20 to downward movement of 90 cents. And then binomial option pricing text template. So there's alternative portfolio. If you buy one share of the stock at 100, borrow at $81, which is a 10% rate, then the net out is $18.18. For replication of payouts and option values, there's the alternative portfolio, which is a one share of stock and 3 calls written. X equals 110. Then the portfolio is perfectly hedged at a stock value of 90 and 120. The call obligation of 0. And then for the 120 stock, it's negative 30. The net payoff is both 90 and 90. Hence, 100 minus 3C equals $81.82, or C equals $6.06.
So we get the hedge ratio, as an example, the rate hedge ratio equals 1 share in 3 calls, which is 1 out of 3. Generally, the hedge ratio is range of call values over range of stock values. That's the formula. Then expanding on, consider 3 intervals. Assume that we can break the year into 3 intervals. For each interval, the stock could increase by 20% or decrease by 10%. And assume the stock is initially selling at $100. This is the intervals of the 3 intervals. And the possible outcomes for the 3 intervals, starting with the $100 value. Making the valuation model practical, increasing the number of sub-periods allowed for a greater refinement. Values of U and D should be derived by the standards. Yeah. This shows the standard normal curve, and that's found in 21.6. This is a Black-Scholes valuation formula. Probabilities from normal distribution using the table of the norms dist function in Excel. We find that n 0.43 equals 0.664 and n is 0.18 equals 0.5714. Therefore, you get this.
Call option value, so the implied volatility. So the implied volatility is the volatility for the stock implied by the option price. Using the Black-Scholes and the actual price of the option, we solve the volatility of it. And basically the question up there is the implied volatility consistent with the stock. What the Black-Scholes model of dividends is essentially the call option formula, which assumes no dividends. One approach is to replace the stock price with a dividend adjusted stock price, to replace the SO, the S minus PV with dividends. And then the put valuation, so we have the formulas up there. So just an example of using 21.4 data, where S is 100, R is 0.1, X is 95, standard deviation is 0.5, and T is 0.5. And we compute it to be $6.35. The put option valuation, so using the put call parity, so the equation up there, and using the data we have P equals 13.7 plus 95 e to the negative 0.1 times 0.25 minus 100, which is, as explained earlier, $6.35. Using the Black-Scholes formula, so hedge ratio or delta, call equals ND1, put equals ND1 minus 1, option elasticity. This is the graph, just shows the call option value and the hedge ratio as the slope goes up. Calling puts results in downside protection with unlimited upside potential. Limitations are the maturity of the puts may be too short, or the hedge ratios or deltas change as stock values change. And then it just shows another graph for the profit on protected put strategy. As we see the change in value of underlying assets. Another graph, hedge ratios changes as stock price fluctuates. So as you see, higher slope is a higher hedge ratio, lower slope, lower hedge ratio. Option pricing, so in the 2008-2009 crisis, some Mern's insight into the financial crisis. When banks lend, essentially they implicitly write a put option to borrow. Borrower's ability to satisfy the loan by transferring ownership is the right to sell itself to the creditor. CDS provide an even clearer example, which essentially is when the firm is strong, slope is 0, firm slips, implicit put rises and slope is now steeper. And as it shows what I mentioned just now, option value is positively related to volatility. If an investor believes implied volatility in an options price is too low, profitable trade is possible. If profit must be hedged against a decline in the value of the stock, as well as performance depends on the option price relative to the implied volatility. The appropriate hedge fund will depend on the delta. So delta is the change in option value over the change in stock value. And this just shows broken down what the delta would be, utilizing all those different numbers. Same thing. The stock price changes, so deltas are used to calculate the hedge ratio change. Gamma is similar to bond convexity. The hedge ratio changes with the market conditions. Rebalancing is necessary. Just shows the call option elasticity as a function of the stock price. So as the stock price increases, elasticity decreases. position in stocks and options that is hedged with respect to fluctuations in the price of the underlying assets or delta neutral portfolio. Portfolio does not change the value when the stock price
You already
fluctuates.
have.
Another graph with a bunch of numbers, and basically shows the value of the profit and hedge put portfolio broken down for different types of stock prices. And lastly, the VS model generates values fairly close to actual prices of traded options. The empirical test shows that the implied volatility actually falls as an exercise price increases. And this may be due to the fears of a market crash. Thank you.
Yeah.
Huh? And then this needs to be filled out. Should be 433. Having checked the ones. Or using them. Sectors, or it should be on one page, same with the Excel spreadsheet printouts. Spaces that
You're firing me up.
I think a lot of this stuff is like and it's got to be Hey man, how are you? Hey, can I call you back at like 1:10? Okay. Yeah. Great. Yeah. Yeah, cool. Yeah. Great. That'd be awesome. Okay. Great. Thank you so much for everything. All right. Thank you. You're welcome. Sorry, I had to cut it. So what I do is I just staple this together. I don't think people that's it. I'm just trying to train you guys. So it's kind of tedious. Do you have a cover page to this? Yeah, do a cover page. Yeah, just do a cover page. Bill on the top. No, I'll do.
You do it.
Yeah.
All right.
And then make sure that those guys, that you make sure you do the active and passive, the memo, and then staple the memo to the Excel worksheets. And then print out the PowerPoint presentations when it's at the page, staple them in the paper, and put them together. And then let me take it together. And if I'll make the last little correction. And then we'll take the individual, reprint them out, but you'll print it out in color at the print shop. So you staple it, and then you'll have the PowerPoint presentation, cover, and then the report goes right underneath it. And then you have that, so once you have the passive report, active report, and then the final report and presentation. So you have those three, then you have the memos, right? So when you walk out of here, you'll have to okay? Thank you. Kevin?
Yeah.
Thank you.
Yep.
You should just have your name, not their name. Okay. Underline your name. Parentheses, United States. Don't do your Then you need something that is next. Did you take my international? And it's not bonding. And you can Deterrence. It's gotta be.
But
It's gotta be stocks, oil, gold, bonds, and US dollar. Yeah. Okay, you just need to.
Yes. So you update the data and then you just export it as a PDF from there. And then
Thanks for your help.
yeah, of course.
What? You coming to the Zoom session? The what? The Zoom session? Oh yeah, he's doing that online, right? Yeah. I mean, that's I think zero. But I'll probably start your own.
That's what my students tell me about every day, and I was like, are you high?
That was for David.
Oh. Well, that makes sense.
saw people wanting to do Star Wars. We're like, we're gonna do Star Wars. Ask me how many times I did Star Wars. 0. I don't know what it is. Bro, I did not. And watching it, I didn't get it. It's so weird, actually. Like, I'm just,
My brother's forced.
I was so confused.
But did you know the rules on the show? Like, is it each minute what I want? Beginning.
Yeah, it is.
But
And then all I did was take notes of like the cool clips, and I found that I focused on transitions, like how they transition, or like when and how. Like,
so I said, Tyler, you Star Wars and cut them right. And what others see. And you built a galaxy in the fault of like going like that.
You have like
So, I would find the film that's what comes
I think we should say this week. That would be a good opportunity because we need to start read and like. Oh no, we're not gonna request it.
because I'm gone. I mean,
So we just read that. Did you hear that?
That was me.
No.
It's a essay.
All the way from over here.
And if we can't find the video, then we can do that
so
shit on
then we'll
Monday.
type it out and they'll read.
Yeah. Oh, this is crazy. Because we don't. You're gone that week, that's fine. But eventually, we can do like our last adjustment. Those two. As we show you like, we don't know how we're doing it, we're not just, it's fine, you know? Because it's an essay, it's not just.
So,
What's wrong with you?
And then after we can do,
and then show clips of that.
yes, yes, yes.
That's where stuff.
Is that you?
First things first, I used to surf waves like that, yeah. Ocean Beach, Steamer Lane.
Gotta start handing out pictures.
Are you serious?
Okay, who's interested in Mass Mutual? Mass Mutual, investment management? No? Okay. FDIC. She just came, they just posted a new job.
I know, I saw.
Yep. Federal Reserve. Travelers Insurance. Who wants to do high-tech placements? Placements, high-tech. This is a great opportunity. You go in, you work for a year, you place a bunch of people, you build relationships with companies, and before you know it, you're jumping off the ship and you're gonna go work for somebody else, right? One of the companies. And then Bio-Rad, right? Bio-Rad's coming on Monday. We're looking to hire 15 people in their FP&A. Okay. So again, I got too many jobs and not enough people to place. Okay. All right. So this is the presentation. I'm only going to spend a few minutes on this, but this was the presentation I gave the other day to the CCIMs, the Certified Commercial Investment Members. There was probably about 100 people in the room. They usually, every January, I usually get, and then mid-year, I usually do 5 of these presentations because everybody wants to know when the next recession is going to be. You know, and how to manage their portfolios and how to manage the real estate. I always start with a disclosure because everybody's always asking me, where should I put my money? Well, you know, if you want to know that stuff, you need to engage with me, right? As an advisor, I just can't give blanket tax and legal advice. Okay, just can't do it. There's my cat.
Oh my goodness.
Yeah, I fed him we had another cat, he was like a little baby cat, so we were feeding her, you know, the baby food,
Right.
kitty food. He ate the baby kitty food and went bald.
No.
Yeah, he was like totally naked. It was hilarious. It took him like a year to like, you know, get his hair to grow back. Freaking funny as hell. So basically the thesis of the presentation was to really talk about the unorthodox monetary policy and the over-accommodation that we've gone through over the last 10 years. And how basically the jury is still out on what the implications and ramifications associated with that over-accommodation has been. But I think the reality of that the financial crisis and the reality of the over-accommodation by the Federal Reserve to basically put a backstop on the Depression created massive income inequality on a national and a global basis that has basically caused the emergence of populist politics that we're basically living through today. I don't know if you watched the impeachment hearings over the last 2 days and 2 weeks, but it's been pretty unprecedented. Okay, so that was basically to talk to them, and the belief too, and there's plenty of books on it. Not only has the monetary policy been unorthodox, but we don't really know the long-term implications and ramifications other than the politics that we've seen. But there's been a massive redistribution of resources and allocation of capital on a global basis to certain groups and industries on a global basis. So there's this unorthodox monetary policy has basically distorted democratic capitalism on a global basis. It's created asset price bubbles that will eventually pop. And the banking system, and right now what you're seeing is the banking system is shored up their capital, so they're in a pretty good position, although they do not want to go to negative interest rates like they did in Europe and Japan. That's the worst thing that could probably happen here. And what you're seeing right now too are the global elites basically start to take their capital and start to put it into cash equivalents to basically store the capital because of an impending recession or another financial crisis. Actually, this model here that I've already gone over with you, we're starting to program it. Okay? Because at the end of the day, we want to be able to value stocks, bonds, and real estate. And you have to have a big data application. And using AI and machine learning and cloud computing now will allow you to be able to do these very, very complex calculations that you couldn't do 10 years ago. I don't know if I showed you guys this, but I went back after the financial crisis. I couldn't figure out what the short, medium, and long-term implications would be on the economy and society and the asset classes. So I started off with the finance model and said, why was there so much volatility in these asset prices? So I used finance theory and the discounted cash flow methods to say, okay, where was the volatility in asset prices coming from? Was it from the numerator and the cash flows, or was it coming from the denominator or the discount rate? So my conclusion was that asset intrinsic value volatility was not coming from the numerators, it was coming from the denominators. Okay? So I checked off the finance box, but I still didn't explain the origins of the financial crisis. So I had to go to economic analysis, and I started looking at Keynesian models and Marxist models, monetary theory, monetary policy. That started to answer some questions using that neoclassical economic frames and filters. But that didn't answer the question either. So then I had to move into the political economy realm, where you start looking at politics, from a competitive market standpoint, and the battle between the two parties based on ideologies. And that in itself started to answer some questions there too. But it still didn't answer the question. So then I had to go to the philosophical models. And I came across the Hegelian dialectic, which was a model that was designed by Frederick Hegel in the late 1800s that was used as basically a frame to analyze capitalism and the failures of capitalism by Marx in his seminal books on critiques of capitalism. And the dialectic, the Hegelian dialectic, is not a cyclical model, it's a dialectical model. This may seem, irrelevant to you, but if you're an institutional investor that has assets and liabilities that are going out 30, 40 years, the questions in their mind are, what is society and the economy going to look like? And what is my portfolio, my assets and my liability portfolio is going to look like in 30 to 40 years when I have to start paying out those pension liabilities? So it's totally relevant because this is an institutional model. And it's relevant for you because you have a 40, 50-year career ahead of you. So you have to be thinking in institutional terms. And the dialectic basically states that there are certain governing theses, governing structures at certain time periods in time that then eventually run through its cycle. The institutions start becoming corrupted and start to decay and then fail. And then the aftermath of that is usually some kind of world war revolution that then restructures the institutional arrangements and alignments, and you arrive at some new antithesis that becomes the new synthesis or thesis that becomes the governing ideology and philosophy on a global basis. So what I did was I traced out the dialectics based off of my knowledge and based on some of the research, and identified 3 dialectics over the last 90 years. And based on the analysis, and I didn't do this on purpose, it just came out, is that these dialectical shifts in society and governing structures, institutional structures, on average last 30 years. So there's been 3 30-year dialectics over the last 90 years. So if the financial crisis wasn't analogous to revolutions and wars, we're within the first 10 years of the first 15 years of the 30-year dialectic. And what you're seeing right now is a global institutional realignment that's going on based on attacking democratic capitalistic institutions that were put in place after World War II. You're seeing an acceleration of that. What does that have to do with finance? It has everything to do with finance. Because basically you have to understand this stuff to understand where the capital flows are going, what sectors and geographies are going to be benefiting, which ones are going to be hurt, and you have to rearrange your portfolios to take advantage of those areas that are going to benefit, and you need to mitigate the damage or sell off or reallocate your portfolios away from the areas that are going to be damaged to the areas that are going to benefit. And it's not easy to move a multi-trillion or a multi-billion-dollar portfolio of stocks, bonds, and real estate assets. It's really hard. It takes like 3 to 5 years to do that. You can't do it instantaneously. So the dialectical model is totally relevant, and my conclusion was that the financial crisis set off a new global dialectic, a realignment, a dislocation, a deconstruction, and a destruction of pluralistic capitalistic institutions, and this is now accelerating due to the use of technology. Okay? Just imagine over the last 5, 10 years what technology and social networking in your phone has done to distribute information within networks very rapidly. So we have to, as investment managers, we have to understand this. The other thing that also impacts asset values is basically the shift in political ideologies represented by parties within the representative democracies or the democracies on a global basis. Here in the United States, this is called the mean voter theorem, which is a public choice theory, which basically takes microeconomics and applies them to politics and policy. And the shifts that have occurred after World War II, which was basically a Keynesian ideology and philosophy, the way things work, started to move rightward more towards monetarism and liberalism as the governing structures that basically govern the economy and govern society. And what you saw was Clinton basically replaced the Republican Party on the right of center. And you can go back and look at Clinton's policies. They looked just like Republican Party politics and policies before. So that pushed basically the Republican Party even further to the right under McCain and Romney, and now you've seen Trump and the Tea Party really push the political policy spectrums to the extreme far right. To be able to pass policy that has an impact on the majority of the populations, you have to form and pass policy within the center, between the two parties, coming together to negotiate, to come up with the policies to be passed for major impacts on the majority of the population. The current state of politics is completely fractured. It's basically binary. It's a winner-take-all scenario, and it is a scenario of mutual destruction. There's no consensus. Why are they battling it out based on ideology? Well, it's based on redistribution. If you can control politics and policy, you can control a $23 trillion economy. You can allocate to certain industries and corporations, demographics, if you control and run the power structures. So it's a situation, we've never been here before, but it makes it extremely hard for businesses to make business decisions, and it makes it extremely hard for investment managers to make investment decisions. So the thesis, the whole approach here, was really to tie politics and policy right into the discount rate. Right into the discount rate. So that was what I was trying to find, or trying to figure out. We all know about the yield curves. See if I can get to my slide that I'm trying to get to. Okay, this is the one right here. So my observation was, you take cap M, and that becomes the discount rate, right? You can take earnings per share, earnings, EBITDA per share, whatever you're using, net operating income, whatever the cash flow metric is, and divide by the discount rate to get the intrinsic value. Or you take net operating income from the real estate property or portfolio, divide by the cap rate, and you get the intrinsic value using the income approach, the first income approach. The second income approach is you go ahead, forecast the net operating income over your holding period plus the terminal value, and you discount it back at the discount rate, and your cap M is your expected return on the equity or your cost of the equity. These NOIs right here follow the business cycle. So if you know where the business cycle, where we are in the cycle, and you know where we're going in the cycle, you can forecast these pretty easily. And these don't change significantly over time. So the volatility in the valuations, stocks, bonds, real estate, is not coming from the numerator, it's coming from the denominator. Okay, so what is the denominator? And I've been asked these questions many times. Larry, we're looking at buying a piece of property or a stock or a bond or valuing a company. What's the discount rate that we should be using? Okay. So the question then becomes, how do you construct a discount rate? Which is your expected return or your cost of capital? Well, if you decompose the discount rate, and I believe that the discount rate volatility is really where the asset price volatility is really coming from. So you have to start off with the base rate, which is the risk-free rate, which is the real rate of return plus inflation expectations. And we also know that the Federal Reserve can print money, buy bonds, drive up bond prices, and drive interest rates to zero. So they can artificially lower the discount rates by driving the risk-free rate to either zero or negative. And then you have to start adding on risk premiums. How are we doing on time?
Done.
Okay, let me just finish this then. Inflation risk premium, credit risk premiums got blown out during the financial crisis. Illiquidity risk premiums, there was no liquidity to clear the markets. Maturity risk premium, currency risk premiums, currency devaluations on coordinated basis tax policy is a big deal. But the discount rate determination is completely left out political and policy risk premiums. We basically assume them away. So theoretically, if these aren't included, your discount rates are artificially low and your asset prices are artificially high. And this was confirmed. These have become a reality now for institutional investment advisors because they did a survey, and this was by Goldman Sachs. More than 30% of high-grade corporate bond investors listed populism in politics as their biggest concern over the next 12 to 24 months. So now that's injected the political and policy risk premiums into the discount rate determination. So the question then becomes, at what point do these policy and political risk premiums adjust upwards and you start to see the bubble burst or the asset prices start to deflate? That's kind of what we're waiting for. Right now, the Fed is so accommodated in driving down the risk-free rate to zero, or actually the real rate negative, that it's basically washing this out. And I think it's pretty obvious after the impeachment inquiry and what's going on politically that this will be introduced into the marketplace at some point within the next 12 months. Okay. Well, that's my little lecture. Yeah, you're welcome.